AMC, one of the beloved meme stocks, but not necessarily hit with the professional investing crowd. To beat the street, you can't think like the street, but in line with know thy enemy, I think it's important to understand what expectations are currently baked into the shares. So, in this video, we're going to run through what Wall Street thinks about AMC, how rankings and price targets have evolved, how the company has performed versus earnings expectations, what are the current estimates for growth and profitability, and finally, how the valuation stacks up with the peer set. So, let's get into it. Before we get too deep, we need to be honest about the state of the business. 2020 was a disaster for the company, and while 2021 had some green shoots from the reopening, people haven't exactly rushed back to the theaters in droves, as revenue for the year was still down 54% from pre-pandemic levels. But even before that, things weren't going too pretty. This nice bump here in 2017 was almost entirely due to a flurry of acquisitions. On an organic basis, growth has been hard to come by. Now, obviously most people investing in the stock are betting on a new sort of Web 3.0 pivot for the business, and I guess maybe a bit on the mining space, but how does the street feel about all this? Well, that optimism about a turnaround pivot hasn't really been shared by the street. Despite the meme stock fueled pop since January 2021, street target prices haven't really budged, and more recently have pulled back following the company's fiscal 2021 reporting in March of this year. And on the rating front, while the sells seem to have subdued, no one on the street as of yet has taken to calling AMC a buy. For all their troubles over the last few years though, AMC has managed street expectations for revenue well, and consistently beat analyst expectations. However, on the earnings per share front, well, it's a damn Christmas tree. You might be shocked by the fact that things actually look more consistent since the pandemic, but there's actually a good explanation for this. As you can see, EPS has been on a roller coaster for the company, as it struggles to find profitability in a consistent manner. If things look more on the ball during the COVID period, it's because the denominator isn't dividing by a number close to zero. It's dividing by a number solidly in the red. On the recovery front, expectations for a speedy turnaround at AMC aren't taken to heart by the street. Consensus doesn't see revenue clawing its way back to pre-pandemic levels until 2024. If they are factoring in some neat new revenue stream that CEO Aaron Adam has been talking about, they haven't given too much credence to it in the other revenue stream, which is expected to only represent 8.4% of 2024 revenue. Even worse, the outlook for earnings per share is bleaker, and not expected to turn positive in the foreseeable future, as the high fixed cost nature of the business is expected to drag the business down for years to come as it toggles its footprint and operations. On the positive side, the street is at least forecasting EBITDA to move back into positive territory in 2022. Hooray! It doesn't sound like much given the state of earnings, but assuming that EBITDA is a semi-reliable proxy for cash flow, this probably means that even under the street's bearish outlook, AMC is likely through its period of existential threat and the risk of insolvency. As far as how expectations have evolved, consensus for AMC's 2022 and 2023 revenue hasn't really shown much of an upswing coming out of the pandemic, with estimates basically flat during the stock's entry into the meme stock world. If upside has been built into the stock from the company's new ambitious pivots, that's been completely lost on the street. The picture has been even more negative on the earnings per share side, with estimates for 2022 EPS now sitting at around negative 80 cents versus a positive 69 cents before the pandemic. Woo! And looking at AMC relative to its peers is where you can really see how much hype is currently built into the stock. Compared to the competition in the cinema biz, AMC trades at a significant premium, at around 40 times EV to 1 year estimated forward EBITDA. That compares to the peer set average of only 7.9, or roughly a 400% premium. Whoa. So what justifies this premium? Well, it's not revenue growth. That doesn't really stand out versus the group. And if we're going from the start of the pandemic, then it's roughly expected to show the same recovery as the broader peer set. And while the picture might look a little bit better on the EBITDA front, this is actually mostly the result of AMC playing catch up with its faster recovering peers, with AMC still not expected to fully recover back to 2019 levels by 2024. For these reasons, the street's target prices for the peer set averaged around a 46% premium to the current stock levels, while it sees AMC's shares overvalued by 70%. So, who's right? The Wall Street Analysts or the retail investors holding the AMC shares? It's not really my call to make, but clearly there are a lot of people that see AMC turning itself around and tackling new markets in ways that the street either doesn't see or doesn't believe in. Either way, at these prices, AMC needs to do something dramatic in order to prove worthy of such faith. Alright, so that's my quick take on what Wall Street thinks about AMC. And if you have any suggestions for what company I should take on next, please let me know in the comments below. And please hit that like and subscribe button for more informative and hopefully entertaining financial content. I'm Ryan, and thanks for tuning into Market Lab.